Good morning. Welcome to Money Beat. I am Paul Vigna. U.S. stocks are modestly higher this morning. First hour of trading. You see the Dow up 40 points. The others are also in the green. NASDAQ 23 points, 0.5% there. We had this morning industrial production came out a little higher than expected. Producer prices still low, so no inflation concerns in the pipeline there. Market liked all that, and you can see what you're getting. However, it has been a volatile month this August for stocks. That is something we haven't been able to say lately. See it market strategist Ryan Dietrich says there's a good reason for that, and he joins us this morning with the explanation. Ryan, good to see you again.
Good to see you as well, Paul.
Congratulations on the new gig over at See It Market Now.
Thank you, Paul. Appreciate that.
Let's talk about August, talk about September, talk about what these months mean for the market. You have a lot of headlines out there, and people are saying, well, the Dow's got to be down on this, Dow's got to be down on that. Everything, you know. But these months are kind of a creature of their own, aren't they?
They sure are. You know, when you look back since 1950, Paul, August and September are the only 2 months back-to-back to average a negative return. So, you know, there is a seasonality factor. That's the big concern I have here. August since 1980, if you look at just the negative months, so when the month is negative, what's it do? August is the most negative, down 4.66%. So when August is down, it's really down. And you look back, you know, since 1990, the Iraq thing, 97, the Asian thing, 98, Russia issues, all these geopolitical things seem to happen in August. It could be random, sure, but now here we are in August again. We've got a lot of these geopolitical things floating out there, so it's something to pay attention to.
That's the question. Is it that all these things just happen to have happened in August? Or, I mean, is there a reason? Is there some kind of market structure, some market internal? What's going on in the markets that would seem to drive it?
Sure, one thing that makes the most sense to me is August is usually, boring is the right word, because we're saying it's volatile, but volume's light. So you got, you know, people aren't around, so it's summertime, into the summer. So when you have an event, you can actually have more volatility because people are like, oh my goodness, look what just happened. Then the volume comes in real fast. And that's what I think kind of sparks it. People
takes less to move the market.
Exactly. And so that makes the most sense to me, why August is kind of that way.
Right. So yesterday was the third lowest volume day this year.
Well, there you go. And if we get some news
God knows
overnight,
what today will be like.
Yeah, but Monday morning, get news overseas or whatever, the volume's going to come back in a big way and get that volatility. Absolutely.
So maybe you don't want to make too much of whatever you see in August and September.
Right.
I would imagine that's your conclusion. I'm putting words in your mouth. But one thing I find interesting in your latest piece is you point out that this current bull market is already the fourth longest on record.
Right.
That's pretty interesting. What do you?
It is.
Why do you attribute that?
Sure. Well, I mean, when you look at the bull markets, everyone says the bull market's getting old. That's a reason to be worried. And there's some truth to that. But what I did, I look back, you know, this is 65 months old, this bull market. We've had 3 other bull markets actually longer than 150 months. So, you know, yes, it's getting old, but I just say it's more mature. There's still, potentially, if you look, it can keep going. Neat stat, S&P 500 up 6 quarters in a row. 1950, that's happened 4 times. 3 of those times, it was up another 4 quarters in a row. We had 14 quarters in a row in the 90s. I'm not saying we're going to have that, but my point is, yes, we've had a really great streak, you know, in this bull run, but it doesn't mean you have to be, you know, super bearish because it's gone for so long. And why is it happening? That's the ultimate question. You know, earnings look good, economy's coming around. I still think it comes down to sentiment. You know, we had that 4% correction recently. Look at some of the sentiment polls. You know, the AII poll came out most bears since last in a year, August 13. The Investor Intelligence poll, lowest number of bulls since the early February lows, the calendar year lows. So these little modest pullbacks, it's, oh, this is the big one. August is scary, and I agree, but that kind of flushes out the fear, and we keep going. Look what's happened. We're doing well again.
You talk about that, and you talk about outflows.
Yes.
I mean, you know, when prices go down, there's a reason for it, right?
Exactly.
I mean, people are pulling money.
Exactly.
Where are they putting it?
Well, that's a great point. You look at the ICI, domestic mutual fund flows. August was the most they pulled out from money, outflows, since December 2012.
That's what you're looking at right now.
Yeah.
That's what you're talking about there.
Right. So, you know, people get worried. Now, where are they putting it? I mean, let's be honest. Those are mutual funds. So much of that money is leaving mutual funds going into ETFs. People are saying, you know, I want to do it myself, which I think is kind of neat because people are taking more, you know, taking advantage of doing it themselves, which is a good thing. But still, just from a kind of a contrarian point of view, there's still a lack of trust of Wall Street. Let's be honest. It's still there, and they'd rather do it themselves. So I still find that kind of encouraging.
Well, excuse me, I'm clearing through here.
Sure.
You still see bond yields are extremely low.
Yeah.
Let's just use the adjective extremely. I saw the 10-year this morning at 2.39.
Wow. Okay.
The European bond yields are just off the charts low. I mean, people are, even at those numbers, people are still putting money into bonds. Why?
Well, I think overall, if you look at bonds, it's kind of the contrarian play. I mean, coming into this year, no one expected that to happen. I mean, now all of a sudden, though, we're starting to see some flows from the money flow or the mutual funds into bonds. So money's coming in. Why is it? Lots of different arguments. My take, if you look at the TLT, that's a 20-year Treasury ETF bond. So the big one people look at. It continues to look good. It's going up. The big thing we've heard for months now is, bonds have done great this year. That's going to be bearish for the stock market. It hasn't been yet. Could it be eventually? Maybe. But my point is, the stock market's doing okay here this year. Bonds have done great. Yields have gone lower. That can continue. Historically speaking, they have gone up at the same time for years before. So it's not bearish for stocks would be my warning there.
It's interesting. We have to go here, but
Sure.
you sort of have the risk takers and the safety seekers are both doing all right this year.
Interestingly, that's true.
That is interesting.
Yeah, exactly. Even commodities are doing pretty well too this year. So
all right, Ryan. Thanks. Good to see you. Talk to you next time you're up in New York.
Thank you.